Hello, I'm Peter DeVito, Senior Advisor with Fairport and Luma Wealth. Today I would like to talk a little bit about charitable gifting and in particular donor advised funds. This popular vehicle remains one of the most effective ways for people to maximize the tax benefits of charitable giving. According to the National Philanthropic Trust, contributions to donor advised funds have increased by 80% in the past 5 years. Grant making was up 93% during that same period and has increased every year for 10 consecutive years. A donor advised fund provides many of the tax advantages previously available only to those wealthy enough to set up private foundations. In fact, many high net worth families now opt to use donor advised funds instead of incurring the costs and time necessary in establishing a foundation or charitable trust. The Tax Cuts and Jobs Act, enacted in 2017, is one of the reasons why donor advised funds have become more popular. It made it more important for individuals to bunch several years of charitable contributions. The law doubled the standard deduction and reduced many itemized expenses previously available. The result is fewer people now itemize on their tax returns, so they receive no additional tax benefit from any charitable contributions. The solution is to bunch expenses all in one year so you're able to fully itemize. A way to do that is to make several years worth of charitable contributions to a donor advised fund and then take the standard deduction in subsequent years. You would still be able to distribute the same amount of money to your charities on an annual basis or whatever schedule you want. In the example provided, a married couple in the 35% tax bracket could achieve over a $10,000 tax savings through bunching charitable contributions in 1 year, then taking the standard deduction in the next 2 years, first gifting annually over the 3-year period. It is still the same amount given in total. Another advantage of a donor advised fund is that you can take the charitable deduction when it makes most sense for you. You might want to make a large gift in a year when you have unusually high income, say from a bonus or the sale of a large asset. This way, you can maximize the deduction when you're in the highest marginal tax rate. A donor advised fund can also be used as a tax efficient way to dispose of an asset in which you have a large unrealized gain. Instead of selling it and incurring capital gain taxes, you can donate all or part of the investment to your donor advised fund. You receive a charitable contribution deduction equal to the current fair market value, and you do not pay taxes on the capital gain. For example, an individual in the highest marginal tax bracket donates stock that was purchased for $10,000. It is now worth $20,000. So donating rather than selling would result in federal tax savings over $7,000 on the charitable deduction at 37%, plus you would save another $2,000 on the 20% capital gain taxes you would have had to pay on the $10,000 gain. It is clearly a win-win for both you and the charity because they can immediately sell the position for cash with no tax consequences. Now, some rules apply depending on how long the stock is held. If the stock has been owned less than a year, the deduction is limited to the cost basis or what you paid for the stock. Stock held over a year can be deducted at its current fair market value. If the stock has lost value, it is better to sell it first than give the cash to charity. There is a deduction limit for contributions of appreciated property. It is normally 30% of your adjusted gross income. If the deduction is limited, the unused portion can be carried forward up to 5 years on your tax return. With the donor advised fund, the contribution qualifies for an immediate tax deduction. Money in the account can be invested in various options to grow tax-free, which allows for larger charitable gifting in the future. Donations or grants to qualified charities are made according to directions from the donor. You choose the amount and date of the gift, and the fund sponsor facilitates the grant request. Though you have an account in your name and can control the grant distributions, just remember, the money no longer belongs to you and you cannot get it back. The account value can only be donated to IRS qualified charities. Unlike private foundations, Donor-advised funds currently have no annual giving requirement, nor pay a net investment income tax. You still receive a tax deduction upon contribution, even if the money is not donated to charities until later years. However, there is a proposal in Congress that would require future contributions to be distributed within 15 years. But even if this change were to occur, it does not appear that it would go into effect until after the end of this year. Most donor-advised funds allow you to start off with as little as $5,000. You can choose a fund sponsored by a financial service company or seek out one sponsored by a local or national public charity. And make sure to compare fees and expenses and to examine any giving limits. There might be a minimum grant amount required. Sometimes this can be as low as $50. Many donor-advised funds will also accept different kinds of assets in addition to cash and securities, including real estate, art, and even private equity. Lastly, you can make donor-advised funds a family activity. Family members can gather periodically to discuss which charities should receive gifts, or you can give each child discretion over an amount in account and let them decide. And because you can name successor account owners upon your death, donor-advised funds can be an effective way to build a lasting charitable legacy. If you would like to discuss incorporating a donor-advised fund as part of your charitable giving strategy, please reach out to your Fairport or Luma advisor, and we would be happy to assist. Thank you.